G'day guys and welcome to another APS Weekly News Bulletin, keeping you up to date and well informed on the Australian property market and everything that's happening in real time. Jumping straight into it guys, story number one, 5 factors to consider before refinancing your mortgage. Article by Sebastian Holloman of Smart Property Investment. He writes, with refinancing surging in popularity over the past 12 months, homeowners must consider whether refinancing is right for their circumstances. Now, wait till the end of this, guys. There's a key thing here that most people don't know about refinancing. Some homeowners can't refinance because they're mortgage prisoners. This is his first point. While rates were around 1.9% 2 years ago, they have now increased to 6%, making it challenging for many to refinance, explained Barbara Giamalis, lead broker at Timely Home. That's because banks always buffer the rate, adding 3% when doing a loan. That means if you're applying for a loan with a rate of 6.14%, the lender will need to assess your ability to service a loan with a rate of 9.14. So that's a serviceability buffer that the banks have to work by. The lead broker stated that those coming off a fixed rate mortgage should talk to an expert to explore options for improving your refinancing eligibility. It was a stage 3 tax cuts in July. It's become a good time to understand how these changes might affect your ability to afford a better home loan rate. For some, these tax changes could unlock the door to refinancing, opening up opportunities for a better home loan deal. Point number 2, he writes, possibility of break-even costs when refinancing on a fixed rate. Breaking a loan to go to a significantly lower rate can encourage large break costs, and you need to check the difference between obviously breaking them, how much you're going to be saving, and how much it's going to cost you. A lot of the time, if you had fixed at a let's say it could be at a very high rate, and you're breaking to go down to what the new rates are coming in at in the 5s, it could be a very big difference if there was 2 to 3 years left on that fixed rate. So work out the costing differences between that. That's pretty much exactly the same as his number 3, which is define your break-even point. So once you break those loans, figure out what that break-even point is, and are you going to be in front by breaking it and going to a new rate, or are you going to be in front by just leaving the loan as is? Cashback deals can be misleading. Giamalis advised that anyone considering a cashback to research beyond just that cashback offer, specifically how the interest rate would compare over time and how much of it will be absorbed by switching fees. So don't get led in by the glitzy of the $2,000, $3,000, $4,000 cashback offer. Make sure that the actual rate and what you're going to get on the back end of it is actually going to put you in a better position than just getting that initial cashback. Now, final point, guys, is refinancing generally increases your overall repayment cycle. So a lot of people don't realize that they may have been paying off their home loans for 5 to 10 years. By the way, guys, this is my final point on this thing, right? So they may have been paying off their home loan for 5 to 10 years. They might only have, say, on a 30-year loan term, means they might only have 20 or 25 years left on their mortgage. And when they refinance it, often the banks will try and reset to the longest term possible. So you may have also already cut your loan down to 20 or 25 years left of that 30 years. When you go for a refinance, a lot of the time, even though your mortgage repayments may drop. Now, if that's what you're trying to do and you're trying to get your mortgage repayments down so you can actually afford to hold it, it's a different story. But if you're just trying to get a lower rate or whatnot, what a lot of people don't realize is that they're going to reset the loan term. So you might go from a 20 to 25 years that you have left, you might reset it and then reset yourself back to 30 years. So you put yourself back to square one, and a lot of the time for saving only a very minimal amount of repayment. So you need to be really careful with that and see what's actually happening here. Is it being reset to 30 years? Is it retaining the 20, 25 years that I have left on this thing? And the big thing to remember here is that when you pay off a loan for the majority of the initial 10 to 15 year window, especially the initial 10 years, you're typically paying off your interest first. This is how the banks make their money. They charge you the interest first, and they expect you to pay the bulk of the principal on the back end of the loan. So refinancing that, you may pull yourself away from that, the huge amount you've paid off on that upfront. From an interest perspective, what you have to realize, guys, is that this is predominantly for primary residence holders. This is where you need to be careful when you've been doing principal and interest loans, or if you've been an investor that does principal and interest loans, this is where you need to be very careful. For most of us, and myself included, if you're an investor and you're doing an interest-only loan, it isn't as much of an issue because typically you might set a 30-year loan term, but the first 5 years might be interest-only, or the first 2 to 3 years, 5 years might be interest-only. If you're refinancing within that period, you haven't paid any principal off anyway. You've just been paying that interest component, which is fine. And then if it goes through and you refinance it from that side, that's completely fine because you're just like resetting that interest-only term, and that's okay. Especially if you're trading properties, you're coming in and out, that's completely fine. I only ever do interest-only loans on properties that I know I'm going to be selling, like bread and butters in the portfolio for that purpose. Cash flow deals can be a way up as to whether we set them on P&I or interest only. It's one of these things, guys, you need to be all over this thing and just make sure you're not extending that loan term unnecessarily. And it's not going to, be an imbalance when you refinance and actually cost you more over the long term if it's not something that you want. The final point on that as well, guys, is remember that brokers get paid on loans settled. Yes, they have a trailing commission on that loan once it does settle, and they obviously get an upfront and they get a trail, so an ongoing component. What you got to remember is that typically after 18 months, there's no clawback fee if a broker was to refinance you somewhere else. But just remember that a broker or a banker, typically a broker, will have a vested interest in refinancing you somewhere else because they're going to get paid again. And a lot of the time, they don't really mind too much about what it kind of does for you. A lot of the time, they might actually push there's a better scenario for you. Just remember that when that loan gets refinanced, they're going to get paid again. You might get put into a worse position. So make sure you're running the numbers on this thing and you're all over it before you go through a refinance, specifically if it is your primary residence. Story number 2, guys, moving on from that is risks elevated. APRA holds bank mortgage rate buffer at 3%. So I'm going to jump into this article here, guys, but for a long time, they've been talking for the last 18, 24 months, they've been talking about the serviceability buffer being brought down because interest rates have gone on such a big run. This here, guys, is the APRA holds banks mortgage rate buffer, serviceability buffer at the 3%. Article by James Ayres and Jonathan Shapiro. The prudential regulator, being APRA, will not relieve borrowers of the 3% interest rate buffer that they must absorb before qualifying for a home loan because the economy faces too much uncertainty from inflation, geopolitics, and leverage. Australian Prudential Regulating Authority Chairman John Lonsdale said he was concerned overall risk levels in the financial system remain elevated in a letter to lenders on Monday after a quarterly review of financial stability. Mr. Lonsdale said that while the level of loan arrears in residential and commercial lending remained relatively low, it is slowly trending upwards. Given the uncertain economic and interest rate outlook, including the possibility of higher cost of living pressures, it is important that prudent buffers are incorporated in serviceability assessments, he said. APRA decided to maintain current macro-prudential policy settings as a result. The mortgage serviceability buffer will stay at 3 percentage points, forcing banks to assess customers on ability to repay borrowings at an annual rate of about 10%. Holding forth on the buffer comes despite some major bank CEOs this year seeking relief from regulation that makes it more difficult to provide credit to households on lower incomes. APRA said on Monday that the quality of new housing lending was remaining sound, while arrears on mortgages and business lending portfolios continue to rise slowly. So whilst arrears are rising slowly, they remain below pre-pandemic peaks, so below long-term average. Looking across the economy, we can see that credit growth for home purchases has moderated from its heights during the pandemic and is now a little below its long-term average. High debt-to-income and high loan-to-value ratio lending made up only small proportions of new lending, and lending standards remain sound, with banks able to make exceptions to their serviceability policy when it is prudent to do so. Fund managers point to the Australian banks' better capitalized balance sheets, leading to lower loan losses through the cycle. Atlas Funds Manager said Australian housing can be viewed as expensive globally, but it sees a range of factors that strongly incentivize households to maintain mortgage repayments in a note to investors on the weekend. To finish, guys, the fellow from APRA has finished here with saying, our macro-prudential policy settings play an important role in guarding against risks in the financial soundness of banks that could, in turn, undermine the stability of the Australian financial system, Mr. Lonsdale said. APRA will continue to monitor bank lending standards, and should we believe a change in macro-prudential settings is necessary, we'll make the appropriate adjustments where needed. In summary, guys, the way our bank regulators and the way that APRA works, and even the banks themselves, and how close they monitor and track pretty much the affordability ratios and serviceability buffers are brought in, is what keeps me so bullish on the Australian market. So many people will kind of, they try and compare Australia to the US and UK and all the rest of it. Literally, APRA in here, even though everyone's trying to ban him and get them to pull that serviceability buffer rate, that is literally what APRA, so the Australian Prudential Regulating Authority on lending, so on mortgages, this is what they are in there to do, to make sure we maintain and we retain stability in the lending environment in the Australian property market. Obviously, the bank have a very vested interest in getting and pull those serviceability buffers back. The more serviceability buffers are pulled back, the more that you and I can borrow. So the loan's at 6% and there's a 3% serviceability buffer, they have to rate you at 9% loan, so a 9% interest rate, which means that your serviceability is only going to be a certain amount. They can only lend you a certain amount. But if that comes back to, say, 2% where it used to be, that increases the amount that they can lend to you. So the banks have a very vested interest in getting that dropped back. And us as property investors, realistically, if we get it back, we can borrow more money and buy more property and all the rest of the sort of stuff. Homeowners can go out there and buy a more expensive primary residence. What you have to remember is you're still going to be paying the same amount. So you're still going to be paying the 6%. but it's APRA's job to make sure that they keep a cap on responsible lending and make sure that you're not borrowing too much money and more that you can afford. I actually don't mind this. Like, obviously, it's going to be good when they cut it back because our investors and you guys out there are going to be able to borrow more and you're going to be able to go and buy more. But they're keeping a very close lid on the economy. Keeping a very close watch on all these things and making sure they don't let these things out too soon, especially with the potential of a rate cut on the horizon, end of this year, moving into next year as well. They know those rates are going to be coming back. So keeping those serviceability buffers in there, it just keeps a level of kind of safety within the property market and within the lending landscape as well. So it's one of these things, guys, it keeps me super bullish on the market. APRA came in and stepped in pretty hard in the 2010s and slowed the Sydney property market. This is literally what they're there to do, is to keep a lid on the housing market and to make sure it doesn't go into crazy times, right? And same as the RBA, APRA, kind of similar from a similar perspective too. So whilst it would be great to do it, it keeps stability there. Now, guys, story number 3 to wrap this thing up. Last bank standing, CBA clings to November rate cut. Article by Arana Durney-Benson over at realestatebusiness.com.au. And she writes, the Reserve Bank of Australia's August cash rate put a dampener on many analysts' hopes for a rate cut this year. Westpac is currently reviewing their previous prediction that rates will fall in November, stating that the RBA Governor Michelle Bullock's surprisingly hawkish comments mean our expectation of a November rate cut is unlikely to be achieved. Meanwhile, ANZ and NAB have held to their predictions that a rate cut will come in February or May 2025 respectively, but the CBA, Australia's largest home lender, is still predicting a rate cut this November, with the bank's economists forecasting the cut in its latest household spending report. Now, guys, I think it's very unlikely. This is obviously just humble myself, making this comment, but I think it's very unlikely the banks are going to be making a rate cut this year. I think inflation's still too high. Still too many things are trying to get under control. The housing market is still exceeding expectations with how much growth it's seeing across the board. Unemployment, while it's slipping, is still quite high. There's a lot of things in the economy that's out there that I think is going to hold off on the RBA pulling the trigger. I think it's going to be more likely end of Q1, probably realistically moving towards the middle of next year is more than likely when I believe they're probably going to make that cut. CBA is going out on a leg and saying they still think it's going to be coming in November. Now, they pay their analysts and they pay their forecasters absolutely huge dollars to make these comments and make these decisions as well. ANZ, NAB are calling February and May. So CommBank obviously going on a limb out there, still saying end of this year. It's going to be very, very interesting to watch. I think there's a lot of factors that are going to come into the equation by the end of this year to really determine what's going to happen. I just think it's crazy to think, really, with everything that's going on, that a rate cut's going to come at the end of this year. If it does, it's going to be great for me and my portfolio and for the investors, but I personally just can't see it coming in until Q1, Q2 earliest next year. So I guess, guys, this will be a bit of a wait and see how it pulls out from that side. Now, listeners, that's a wrap for another APS Weekly News Bulletin. I hope you took some great value from this episode. If you did, please make sure you send it on to someone else that you think might also take some great value. If you're not following us yet, make sure you hit follow or subscribe on your favorite listening platform. And if you haven't left us a 5-star review yet and you're loving the potty, please make sure you jump on there, you leave us a 5-star review. And until next week, guys, that's another APS Weekly News Bulletin on the Scouting Australia podcast.